I think the best way to describe the technology sectors for the past few years is FOMO, fear of missing out. Between 2019 to 2021 or early part of 2022, a lot of people who have missed out the earlier tech boom, they have felt that they don't want to miss out this opportunity in this time. And they're rushing in very quickly into many of the technology investors, especially sectors which are at that time considered to be very exciting and very hot. Software as a service, artificial intelligence, deep tech, and many of these sectors. The FOMO set in, so valuation was driven out to a very unrealistic expectation. But of course, unfortunately, because of the many factors, first economy slowdown, Ukraine war, and so on and so forth, and that FOMO effect has been taken over by the jomo effect, which is a joy of missing out. So many other people thereafter, today in the environment, most people are feeling more cautious, more careful, and more willing to step aside and not do anything, and waiting for other people to take the lead versus themselves jumping in early, like what used to be on the FOMO effect.
Shares of the mega cap tech names falling with the rest of the market, Kelly, with those losses extending into this afternoon.
So I think first thing happened was the later part of 2011, early part of 2022. Generally, the public market have came down quite significantly. So that public market effect has cascaded down to the private market. In most markets like US or even Israel or even China, or increasingly more Southeast Asia and India, you are seeing that private markets investors are also referencing to that down market, are more cautious and more careful in investing. And so as a result of this, you can see a lot more private investor, venture capital, or private equity investors are taking a much more slower approach in investing. Sometimes I think a lot of companies that, even though their performance could be 3 times better than last year, they are finding it harder to raise money. So in this kind of environment, I think we should continue for a while. People are more cautious, people are more maybe pessimistic about the future. They will probably take a more wait and see approach. And so therefore, I think this will continue for maybe at least about 12 to 18 more months before the market will eventually recover. I think in Southeast Asia and India, generally, there's a lot of venture capital firms have raised a lot of money over the past few years. But I think a lot of them have also overinvested a lot more over the past few years. While I think generally on paper, the dry powder's a lot. Many of them actually have to allocate some of this dry powder to their own portfolio because as I mentioned earlier on, even the company could be performing 3 times better, but people are not, willing to, invest. New investors are not prepared to invest in this kind of environment. So you have no choice, but maybe perhaps have to continue to support some of your better performing company. So while dry powder is still pretty good, healthy, but I think you'll see a lot more existing venture capital firms allocating some of their dry powder towards their own portfolio, doing less in terms of a new portfolio. But then, when markets recover, the better people are more, aggressive in investing again. Hopefully, this will, reallocations of dry powder will be, somehow, to be more new investments in the future. In good time, bad times, there will be a lot of good entrepreneurs starting companies. But I think that will not change, whether a good time or bad time. The difference is that in this kind of environment, you probably cannot command as high as a valuation. So it's a fundamental mindset that the entrepreneur had to recognize. Second thing that they had to recognize, and in this environment, you need to focus very much back to what is always an important factor is your technology, your business model, how disruptive you are, and how much your competitive advantage to other people. So this is something that's very important to continue to build and continue to be work on. And last but not least, of course, it's about it's about financing, right? You need to raise enough money to create the sufficient runway to execute your plan. And bear in mind that this environment could continue to be tough at least for 12 months, if not 18 months. So you must make sure that you raise sufficient capital to take you through to the 18-month cycle. When market is better, then you are able to show your strong performance. People will be more willing to invest in your company. Any market, there will be always the ups and downs, right? And when there's a fear of missing out comes in, everybody rush in. the market will run up to unsustainable level. And then when everybody suddenly realizing that this is this is not sustainable, everybody start selling down, and then you will undershoot, right? You will get to a level now that it's probably some of the company are undervalued. So I think this cycle will continue, but general trend of technology sector, even though you may be cyclical, is on the trend upwards. So this is something that's important. So which is why important especially in venture capital sector. I mean, for 2019, 2021, I keep reminding some of our colleagues that we have seen this before. When market is overshoot, we have to slow down. We have to slow down, which is not easy. It's not easy at the point in time. Because people are all thinking that if we don't rush in, we may miss out. But that's why it's very important to always remind ourselves that we've seen it before. I think one of the things that we mentioned about the old adage about that if we have learned things from history before, and then if we don't learn from history, we'll repeat our mistakes again, right? So it's important for us to see this time now, and many of our younger colleagues have never seen this before. So learn from this kind of environment. Next time, when market recover, there will be a period of time that where FOMO set in again. Just remind yourself that we've seen this before. So we had to slow down. And then when the market come down, like what happened in 2022, you had to speed up, because this is a time whereby a lot of people are not competing against you. And this is a time for you to pick the best company, best opportunity to invest. And venture capital fund, which invest during this so-called low period of time, generally will perform the best in terms of returns. And history has shown that for many times. Many venture capital funds which are very active after dot-com bubble shown to be a top performing venture fund. And I think the next 1 year, 1.5 years, those venture funds who are actively investing in this period of time likely to be shown to be a top performing funds.